Let's talk about the 7 factors that influence mortgage rates. If you're a buyer or you're an investor, you need to pay attention to mortgage rates and why they're changing. And today we're going to talk about those specific factors that cause them to change over time. Now, understand the mortgage market is huge. It is global. So the factors that we're going to go over, they all work in conjunction with one another. Not one of these factors is the final determining thing that's going to ultimately set the rate that you're going to pay. But each one of them work together like a giant concert. And then at times what happens is one of these factors will pull harder than the other factors. Inflation is one of those factors. Inflation causes the purchasing power of money to go down. So what happens is because money doesn't go as far, lenders start to demand higher rates because inflation is so much higher. What they're doing is they're actually protecting the investors and they're protecting mortgage-backed securities. So as inflation rose over this last cycle, what we also saw was we saw interest rates dramatically rise. Why? Inflation is a key factor in changing and setting interest rates. The lender also has to ensure that the loan is wildly profitable, or there's at least profit inside of it. So if their borrowing costs are going up because of inflation, they have to raise the price to the consumer to ensure the loan is profitable. Item 2 on the list is mortgage-backed securities and bonds or treasuries. So high inflation will typically lead to higher bond yields. And what happens is the mortgage-backed securities market, it mirrors the bond market. So that inflation comes up, it causes bond yields to rise, and then interest rates that us as consumers then rise right along with it. One major point I want you to understand, lenders have to make mortgage-backed securities slightly more attractive than bonds. Because as both of them are providing the same yield, what's happening is they're actually competing for the exact same investor. So as they're competing for that investor, the mortgage-backed securities market is going to move more than the bond market to entice the money away from bonds. Because you have to think about this very simply. Would you rather put your money into a mortgage-backed security that's only backed by mortgages, or would you rather put your money into a bond that's backed by the full faith and credit of the federal U.S. government? So they've got to make it a little bit more attractive, and they have to make them move together. Item number 3 on the list is economic growth and economic risk. Economic growth here in the United States we measure as the GDP. As the economy is growing and GDP is expanding, generally speaking, there is now more people employed, and that more people employed leads to higher demand, and that higher demand means there's more money that's being asked for. In other words, the demand is higher on that money. That actually causes rates to rise. As the lender feels more and more comfortable about the trajectory of the economy, what they then do is they start to relax those rates so that more people borrow. So in times of economic uncertainty, what happens is rates will naturally rise because of the risk to the lender. At times when the market is really good, rates will rise because the long-term trajectory looks good and the risk of default looks low. However, when it gets too high, like we were just talking about, that demand for mortgages becomes so high, lenders are now going to raise rates to slow down that demand. That's why we said all these factors work in conjunction with each other. They're a teeter-totter that sometimes they're pushing, sometimes they're pulling, and sometimes they're all weighted to one side. On our channel, we always go over things that help you in real estate as a real estate investor or a land developer. And so you need to subscribe and be a part of this journey and connect with us as we go along. As always, leave your comments, hit the like button, and share this with someone else who needs to know it. Next, we have the Federal Reserve. So the Federal Reserve sets monetary policy for the United States. What their job is, they have a dual mandate. The dual mandate is 2% on inflation and full employment. This is the same thing. It's also one of those teeter-totters again. It's hard to balance both sides of this equation. What happens is when things get out of control and inflation gets too high, the Federal Reserve will raise rates in order to cool the economy down. Conversely, when things get hard, like in the great financial crisis, what they can do is they can lower interest rates in order to quickly spur on demand for mortgages and make borrowing cheap to stimulate the economy. What happened when inflation got really high was the Federal Reserve had to hike interest rates really quick. The longest we've seen since the 80s. And interest rates went from basically 0% on the Fed funds rate to 5.5% over an extremely short-term period, right around 6 months. What happened was that caused the economy to slow down and to cool because the Federal Reserve, their rate is what's called the overnight rate. The overnight rate happens literally at day zero. When Bank of America wants to borrow some money, this is the rate they'll loan to Bank of America for liquidity purposes or so that Bank of America can loan it out. But what happens is this now, because it's at the front end of the rate curve, it starts affecting all rates thereafter. So then it affects all businesses. It affects all consumer debt. So credit cards, cars, lines of credit for the business, lines of credit for the consumer, because the borrowing cost for the bank went up. So in times of uncertainty and to cool down the inflation, the Federal Reserve must raise rates like they just did. Now we're starting to hit a cycle where the Federal Reserve is getting ready to start lowering rates. And we just saw a 50 basis point cut. What happens is that doesn't instantly go out into the market. That starts to slowly filter out into the market. And a lot of the times the mortgage-backed securities market and the bond market will price in the Fed's move before they actually do it. So during this last cycle, what actually happened was interest rates went down before the Fed even talked. And as interest rates went down, when the Fed talked and lowered rates, interest rates actually slightly popped up for a day. So they'll pop up for a week or two, then they start to cool down again right after that because the market is pre-anticipating the move of the Federal Reserve. Like we had mentioned before, the bond market is one of the major influencers. And if we're looking at residential debt, what you need to do is you need to follow the 10-year Treasury. The 10-year Treasury will most accurately mirror 30-year fixed debt for the residential real estate market. And as they move up, they will move up and down, generally speaking, in conjunction. However, you will find a point at which they're just going to totally diverge. What I want you to do as you start to get into this process is you're going to need to connect with an amazing real estate broker in your area like us. You can reach us at resg.com. And you've got to connect with an amazing mortgage broker who knows the market, who's watching these economic factors, who's watching the MBS market, watching the bond market, so they can tell you when the right time is to lock for you to get the lowest interest rate possible. The relationship between bond prices and mortgage rates is actually an inverse relationship. They're going in opposite direction of each other. When bond prices rise, the yield on the bond falls. This leads to lower mortgage rates. Conversely, when a bond prices fall, yields rise, resulting in higher mortgage rates. This inverse relationship exists because bonds and mortgages, they compete for the exact same pool of investors. And I know we mentioned this earlier. So when an investor finds a bond more attractive, they may demand a higher yield from mortgages to compensate for that opportunity cost. So the rule of thumb, when bond prices rise, yields fall, and we get lower mortgage rates. The next factor influencing mortgage rates is supply and demand inside of the housing market. When demand is low, lenders will start artificially lowering rates because they are a bank. They have to loan money. It's their business. So they start lowering rates in order to get more buyers to go take out mortgages. Conversely, in the housing market, if supply is low and demand is really high, what'll happen is lenders will start raising rates to compensate for that high demand because they only have so much money to lend out. One of the secret tips that you have to watch and follow, in addition to kind of this supply and demand argument, watch out for government policies that may artificially increase supply or artificially lower demand. For example, when a politician comes out and says they're going to offer a first-time homebuyer credit, what's going to happen in that situation is that's, generally speaking, going to artificially increase demand for the housing and artificially increase demand for mortgages. Therefore, debt will get more expensive during that time period. I personally have saved myself tens of thousands of dollars by watching this activity. If you know it's going to go into effect, make the move before it goes into effect or as the program is winding down. Play both sides of that equation. The next item that affects mortgage rates is what's called the spreads. The spreads are built-in margin that the lender is charging that they're just collecting right up front. And the way to look at the spread is the difference between the 10-year treasury and what the average consumer is paying. As risk goes up, that spread will naturally rise. Because we've been in a higher risk environment due to inflation and the slowing down economy, the lenders have raised that natural spread. That natural spread, usually, historically speaking, has set at about 1.7% or 170 basis points between the 10-year treasury and 30-year fixed debt. Today, that is sitting at 2.5 or 250 basis points. In the peak during high inflation, that got to 280 or 2.8. So that spread is naturally compressing right now. So even as the Fed starts lowering rates, realize that there is still 3/4 of a point that'll naturally come out of the market, regardless of whatever the Fed does, as that spread naturally collapses, as lenders feel more comfortable, as they start competing for more people, as inflation shows it's all the way under control, that spread will naturally collapse. Lastly, and a lot of consumers aren't really thinking about this, your credit score and your financial health is the one thing that will actually have the most dramatic effect on the rate that you're able to achieve. The rate that you're able to achieve is based on your credit. So if you have an 800 credit score, aka A++ credit, you're putting 20% down. Your debt to income ratio is low. You have money in the bank. You are considered low risk. What that means is you're going to get the best credit, best rating humanly possible. Conversely, if you've got barely a 620 credit score and you're putting 0 down, you will pay more for debt. And I don't want to discourage you. As a first-time home buyer, even with imperfect credit and not a lot down, we have helped thousands and hundreds of homeowners get into properties who didn't have perfect credit. What we do is we go meet with the lender, we figure out where you're at today, and we create a game plan so that we can make that rate affordable. If you plan to do something like that in the next 6 months to a year, whether you're a home buyer or an investor, meet with the lender early and let's get that process moving with them. In summary, we will dig through each one of those items with you, and who you need to know is you need to know the real estate broker in your area who has a pulse on what's happening in the market and where supply and demand is sitting locally and where it's trending, both short-term and long-term. Second, we've got to get together with an amazing mortgage broker who's going to shop around for you in order to get you the absolute best deal. That's how you start assembling this team in order to get the best rate possible. Because at the end of the day, if you're a home buyer, it's not always about purchase price. It's more about what do I have to pay monthly. And if you are an investor, the monthly payment will massively determine your cash flow. You can reach us at resg.com. Thank you for watching. Hit the subscribe button. Let's connect.